KEI Industries, a company which is into cables, stainless steel, wire business and undertakes EPC projects, has seen a large part of its business get impacted by the COVID-led lockdowns. In our Ideas for Profit today, I'll discuss what's the outlook on the company and whether investors should keep this stock on their radar. Well, the company has delivered close to 31% drop in revenues in Q1, and that's on a year-on-year basis. Now, its largest segment, the cable business, saw a decline of close to 24.4%. Now, among the other categories, housing wires saw the highest 40% year-on-year decline in the revenues this time. EPC business had larger impact because of the lower execution and stop of work at its various projects. Now, the segment reported a steep 43% year-on-year drop in the revenues. Now, in terms of profitability, it reported a close to 60% drop in EBIT. Now, on a relative basis, you talk about the cables business, which saw a mere 15% drop in the EBIT. Overall, the consolidated EBITDA fell by 36.5% year-on-year. Well, on a positive side, the higher other income and the lower taxes did help the company to protect its profitability. So the net profit fell by 21% on a year-on-year basis. Now, its EPC business, although, has had a strong order book, which could face challenge both in terms of margins and execution due to the issues on the ground right now. Now, thankfully, the balance sheet remains quite strong even now. The company recently did an institutional placement as well of shares at 500 rupees per share and raising close to 500 crore rupees. Now, most of this fund is being used for the retirement of the debt and also meeting the additional working capital requirement of the business currently. Now, the debt levels will come down further and the interest costs also will drop significantly going forward. The expectation going forward is of a drop in earnings in the current fiscal year, but overall the growth should resume in the fiscal year 2022. Now, it is sitting on an order book of close to 2951 crore rupees, which is a good indicator of the revenue visibility going forward. Now, stock has fallen in the last couple of months due to the poor sentiments in the market. Now, in terms of valuations as well, it is trading at 9 times the FY22 estimated earnings, which is quite reasonable in the light of the earnings growth going forward. Now, strong balance sheet, strong return ratios and also margins, that's a positive. So investors could therefore look at accumulating the stock on dips for the long term.